Hello and welcome back to the channel Implied Investing. Today we are going over ticker symbol WEEL. We are going to be talking about the WEEL option. This is a very popular strategy with people who have enough enough of a position to run their own WEEL strategy, and now somebody has put it into a ETF wrapper. We're going to dig in, find out what's good about it, find out what's not so good about it, check out their options, and talk about perhaps maybe it's right for you. But before we dive into that, let me go ahead and get the legal disclaimers out of the way. I am not an investment professional. This is not investment advice. It is for entertainment and educational purposes only. Before making any financial decision, please consult an investment professional. All right, with that out of the way, let's dig in. So the wheel uh, has a yield of about 12.6%. This is a pretty decent size yield. It has 21% returns, $27 million under management, a high expense ratio of 90, almost 1%, just basically 1%, and a moderate to high risk ratio. And mind you, the high side, when it's saying moderate to high, you're comparing it to a buy and hold like VOO, right? To VOO. Compared to that, it's moderate to high. But compared to half the other ETFs that we talk about on this channel, it's pretty safe. It's a pretty safe bet compared to the other ETFs that we talk about. Now, the wheel is by Peerless Options. This is a very small issuer. They're not very big. Their options are handled by Title Investments. The fund was created in May of 2025, and Eric Thompson is the manager. So they trade about 1,200 shares a day. What that means for you is that if you do decide to hop into this ETF, you need to make your own bid and ask, because the spread is going to be pretty wide. So what is the wheel strategy and how does it work? So the wheel. So first, they write a cash secured put. The fund writes out of the money put options on sector ETFs. Collateral is held in Treasury Bills and the money market funds, providing downside buffer while generating premium income. So a lot like a covered call where you're selling the upside, like, hey, I will sell you my upside. If the price hits this, you can take it away from me. It can be called away from me. They are selling, they're buying cash secured puts, which means if the price drops to a certain point, I will buy these, I'll buy these ETFs from you. Now, if the price does not go that low, then they just keep that premium income and distribute it to you. Assignment and acquisitions. So should the underlying ETF decline below the strike price, shares are assigned to the fund. The fund acquires the position at the strike price, less the premium already received. That's just what I explained. And what they do is after they get assigned, if they get assigned, they turn around and write cover calls on the underlying asset. Once assigned, cover calls are written on the acquired position. This generates additional income whilst awaiting price recovery. The position is held until called away. This can be a very profitable cycle. It's a very profitable wheel. It's rinse, wash, and repeat. Cash secured put, signed or don't get assigned, and then you turn right around and you write a cover call on it. Moving on to the next slide. So here are here are this ETF's holdings. These are some of the most interesting holdings and probably the most diversified holdings that you will see in an ETF. You'll see that a lot of the fund is held in financials. So financials, Spider Select, uh, another Treasury Bills, quite a bit, and a little bit in silver. So a lot is held um in T bills, but that's common of funds like this. But they have energy, select, financial, technology, ARK Pay, which is ARK Investments. Kathy Woods, that's their flagship innovation ETF. You have China, a China ETF at 3.4%, healthcare, industrials, silver, gold. So you have a very, very, and technology, XLK. You have a very diversified group. I would say that this stuff is very, very uncorrelated. If silver tanks and gold tanks, that has nothing to do with healthcare. If financials tank, that has nothing to do with potentially technology. And lots of T-bills. So T-bills are its number one holding. Everything else is held at a much at below five, roughly below 5%, and they write covered calls on them. And moving on to the full portfolio view, taking seeing that they have 63% in T-bills, 18% in equities or ETFs, and then their option writing represents 9% of the fund. What we can see from here is the covered call and equity positions. 18% in ETFs are in assigned positions, and you'll see that on the next slide. That some of they don't get away with it all the time. If the market takes a dive, then they're going to get assigned. Their options are written roughly monthly. Out of the money strikes provide downside buffer. Several puts currently in the money. Sector diversification across holdings. They await price recovery. So let's take a look at those options. Actually, you know what? I have a better slide for this. Bear with me. Let's just go to the notes. Okay, so here you can see what puts they wrote on which assets. So RK, basically all of the ETFs have puts on them, and they expired on the 1st. I'm sorry, they expired on the 30th. So most of them are out of the money, slightly out of the money, deep in the money, in the money, deep in the money, in the money, in the money, in the money. If you remember the way January closed, there was a pretty broad market sell-off, partially due to just the system de-leveraging itself and de-risking itself ahead of the Fed chair and a potential partial government shutdown. So the market sold off. A lot of their strikes got hit. And what they're going to do is turn around and sell covered calls on them. They're going to sell covered calls on them. All right, back to the PowerPoint presentation. Let's get this back up and running. Well, before we do that, let's check out Seeking Alpha. I'm not an affiliate, but as you can see, I end up using this website quite a bit. If you're any sort of investor, I can recommend this with no problem. So the wheel reminds me of a JEPI mixed with a SCHD. It has very blue chip style holdings. It pays quarterly, but it does give you the price performance of a JEPI. So this is year to date. Let's go back 1 year. The fund's relatively new. It only opened in 2025. So if you go back 1 year in terms of price return, for the wheel, 0.04% price return, and JEPI did 0.24, negative 0.24 price return. But that is price return. We are looking at total return. And in the total return category, it beat JEPI. It beat JEPI. Let's find out if it beat JEPQ. Let's just take a quick look here. Price return, total return. Nope, didn't quite beat JEPQ. Really on the higher side, JEPQ beat it by 3 points, but it did perform better than JEPI. And JEPI is the largest covered call ETF in the market. I think it has a market cap of about 30 billion, and it beat it. It beat it, and it has a more diversified portfolio of equities. It's probably way less beta to the S&P. Well, of course, it's less beta than the S&P 500, but it has a way lower beta. It's way less risky than JEPI, and it outperforms JEPI. All right, going back to our PowerPoint presentation. Here are some of the risks. The option wheel strategies. Obligations to purchase assets at unfavorable prices if puts go in the money. Upside is capped when the shares are called away. So that wheel strategy, you have to buy it at an unfavorable price, and then you have to sell the upside. Derivative risk, we all know that it's using options, so that's always a risk. NAV erosion. NAV erosion is not a risk with this fund. What is a risk is that it is a small fund. It is a very, very small fund. It's only $27 million in assets under management. It's not by a big issuer or one of the hot issuers. It's not by Tappan Alpha. It's not by Neos. It's not by Curve. Those are the issuers who are really, really growing. So unless if this fund ever hits hard times, there is a real possibility of it collapsing, and they'll just return you your money. Limited track record. It's only been out for a year, and concentration flags. I wouldn't really think about it as concentration because it's not concentration. It is really, really well diversified. And here's more comparisons, not just to JEPI, but to QYLD and XYLD. As you can see, it has the highest distribution yield, and it also has the highest expense ratio. It has the smallest assets under management. It has the lowest track record. It delivers quarterly versus monthly, daily volume of about 12K, and it has a monthly premium target of about 0.8 to 1. Okay, who this may be appropriate for. Focused investors seeking 12% yield. Like I said, if you like SCHDs, blue chip holdings, and quarterly distributions, but you like JEPI's higher return, this is for you. This is for you. It is not for people who want to get paid every week. It's not for you. It's not for people who want highly volatile assets. ARK-K is volatile, but that it's nowhere near what a curve is, right? It's nowhere near what a curve is. Um, those who understand options wheel strategies, if you don't have the time to run the option wheel strategy, this is a good fund for you. If you always wanted to run it but you can't, well, you can hire somebody else to do it. You can buy this fund and they'll run the wheel strategy for you. Small position size only, greater than 10K liquidity, tax advantage account holder. So you can hold this in an IRA, a Roth, or a 401k, speculative satellite, not a core holding. This should never be your core holding whatsoever because it doesn't have tremendous price appreciation. Investors accepting fund specific risk potential alpha and comfortable with quarterly distributions. One more thing that should have been on here is that it only has one fund manager. There's an interview out there with him somewhere, but there's just one fund manager. So if something happens to him, the strategy may not continue. Who it may not be for, conservative investors. It is for conservative investors. But I mean, like, if all you are is a VU and chill, then no. But if you want something less volatile, then if you want to mix between a proper covered call ETF and a straight up long-term holding, this might be for you. Those needing monthly income, large position traders, there's not enough liquidity, investors requiring proven long track record, taxable accounts, core portfolio allocation, index investors seeking market matching returns, and those uncomfortable with option strategies. This fund is not for you. Um, Strengths, I'm gonna just go over some of the more important pieces of information from the notes right quick, and then we'll wrap up. We'll wrap up right after this. Um, the strategy is truly unique, and that's something that I strive to bring to this channel is like truly unique strategies. Now, of course, I'll cover the popular funds, but I do videos on funds like ISSB, and FK, YLD. Devo, not a very unique. Well, it is a unique fund because it offers real price appreciation. So I hope that this review was helpful. You're not going to see any NAV erosion with this fund, but your returns, just get into that. That's what I wanted to bring up. Returns are going to be not qualified income. It is not qualified income. They are writing on ETFs. They are not writing on the indexes. So unlike SCHD, where it's qualified dividends, this is going to count as ordinary income. This is also not going to give you those 1256 contracts so you can get the 60/40 split. This is just going to be ordinary income. So if you're not making a whole lot of money, don't worry about it. But if you are on that border between tax brackets, this could potentially push you over the border, or even though the yield is not that high. Well, how would I use this in my portfolio? Only way I would use this in my portfolio is a if I was thinking about getting JEPI, I would get this instead. That's how I would use it. Its yield, I mean, its expense ratio is justified by the yield it gives. It is broadly diversified. It is, I would call this a defensive position because it's so diversified. Most of the yield that you're getting is coming from T-bills, right? It's a T-bill. It's a Treasury plus. It's a Treasury plus a little bit of allocation toward uh toward equities, very similar to like a target date fund where toward the end of your career, most of your holdings are treasury and you got a little sleeve worth of equities. This could go nicely with that. This is not for somebody who's trying to hit fire, financial independence, retire early off of 300,000 or $500,000. This is not for you. This is somebody who has finished the race, have hit that has hit their target of 1.5 to $2 million, or maybe even $1 million, and now are just trying to make some income off of their portfolio. With that, I'm gonna go ahead and end the video here. I want to thank you. I want to remind you all to like, subscribe, and leave your questions or comments in the leave your questions in the comments section. I really do appreciate the support. God bless, and you guys have a wonderful day.